Hello and welcome to this session. This is Professor Farhat, in which we will keep working with the general pricing approaches. In the prior sessions, we looked at cost-based pricing. We looked at value-based or market-based pricing. In this session, we would look at competition-based pricing. And if you're not familiar with the cost-based pricing, we start from inside the firm. We take the product cost and add to it a markup to reach the price. In a value-based, we start with the customers in mind, and we charge what the customer perceived value to the product. Then we will work backward to manufacture or to create our product. So we covered those two sessions in those two topics in the prior sessions. In this session, we will focus on competition-based. Here we will start not with our cost, not with the customers. We start by eyeing our rivals, our competitors, and we're going to anchor the price to what competing sellers charge for familiar product. So we're going to look at our competitors, and this will be the base for our pricing. And we're going to discuss three different methods: the going rate pricing, the competitive bidding, and the target costing. Now, I want to always remind you that in the real world, companies use a combination of those three. They don't only use cost-based. They might use cost-based plus value-based, plus they look at the competition. But for you as a CMA candidate, as an accounting student, as someone studying for a professional certification, we teach you those concepts separately because it's not being deployed in the real world. In the real world, you use them all at once without even naming them. So competition-based is covered here through going rate pricing, competitive bidding, and target pricing, all anchored to external market, but differing in how directly a rival price drives the decision. Now, I don't want you to think we are copying the competitors. That's not what we're doing. We're looking at the competitor as a guide, but not only any guide as a strong guide. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
My AI turns any lecture into a complete study system. You can create summary table, formulas, and example from each lecture. Flashcard builds from the lesson itself. A quiz build on the lesson. And as a bonus, convert any lecture into a portable short audio on the go. So it helps you with the retention. No noise, no generic responses, just clarity based on that specific lecture. Don't just watch, interact, test yourself, and retain the material using Farhat AI. Now go to FarhatLectures.com now and see how the AI can help you understand, practice, and retain the material.
So what's the core idea of the first method, the going rate pricing? Well, set the price by reference to the prevailing market price. So we'd look at the market price, and the company will anchors on what the market already charges, not on its own cost and not on the precise reading of the customer value. The best example of this is, think of gas stations. Sometimes you're driving down the street and there's 3 gas stations next to each other, and all the prices are pretty much closer to each other. Guess what? When they set those prices, they take their neighbor gas station into account. So this is the core idea of the going rate pricing. So that's the best analogy I can give you. And in this type of business, the cost to consumer to switch from one supplier to the other is zero. You can go to this gas station, you can go to the other gas station. So the going rate is treated as a reasonable market-tested price that deliver a fair return. So the firm essentially adopted as a starting point. Again, it's just only a starting point. Now, what defines this method? Again, the competitor price, not your cost. Now, of course, you want to take your cost into account, but the competitor price is the dominant input, the main input. Now, going rate does not mean you charge exactly the same price. So if you're looking at 3 gas stations, one might have the price of a gallon or a liter for $3.79 per gallon. Another one might have it at $3.70. Another one might have it at $3.85 per gallon or per liter, whatever country you are listening to. So this is how it works. So a firm may price at a going rate above it to signal premium quality or service. So some gas station, they would say, you fill the gas with us and we'll clean your windows or we'll wash your car for free. Or you might price your product below the average market in your area to win volume, to take customers. So the label described the anchor, not an identical price. So keep that in mind. And when is that method dominant? So when do we use this method? Well, when we are selling homogeneous commodity-like market. Like what? If you are selling refined sugar, regular grade gasoline, bulk grain, those are all homogeneous. They're the same. The buyers see little reason to pay one seller more than the other. Unless, for example, unless in your gas station you can offer them free coffee. You would say, you can go inside and get a free coffee. Then they will stop at your gas station if you're willing to charge them a few pennies more, for example. So you have to differentiate yourself, and we'll talk about that. So the prices cluster tightly around a common level. Remember on the prior slide, I said it's around $3.80. Smaller firms usually follow the lead of larger firms. So usually in this type of industries, the larger firm set the price, the main price, and everybody else follow. Now we're going to see what would happen if a smaller firm tried to set the price. You want to charge more, price sensitive buyers leave. If you want to charge less, a price war, the small firm cannot win. So you have to be careful if you charge much more or much less, because if you're too small, you may not be able to do it. So let's assume we have this example. Crestline Fuel, a small independent gas station, sits among 3 national brand gas stations. So the national brand, they have a deeper pocket. Regular unleaded along the corridor, on average $3.29 per gallon. Posting 3.39 cents commuters across the street. So if you said, I'm selling for 3.39 and they saw it's around 3.29, they are going to go somewhere else and not use your gas station. Posting 3.19, you invite the deep pocket chain to match and erase your margin. So what would you do? Well, Crestline prices at the going rate and so what should Crestline do? They will price their gasoline at the going rate and compete maybe on faster car wash, stronger loyalty program, or say come inside and get you a free coffee. So the market sets the price. So they may charge $3.33 or they might charge $3.25. If they charge a little bit more, they might they try to differentiate themselves. So the real decision was how to differentiate around it. So if you're charging a little bit more, what else are you offering? Now what happened, you remember we said the leader who usually sets the price. Who's the leader? The leader is with the company with the strong pocket, the largest market. They set the price and everybody else follow. So what happened when the leader is undercut by lowered priced rival? Well, always the leader should have room to maneuver. Room to maneuver means because they have deep pocket, they should do something else. What can they do? Well, cutting the price should be usually their last resort. That's the first thing you need to know. So what can they do? One thing that they can do is they can hold the price and raise the value somehow. They can invest in quality, service, warranty, or brand so customers accept the premium and stay. So we're talking about something other than gasoline. Let's assume they're selling toasters or they're selling, blenders or whatever they're selling. They'll try to have to keep the price but raise the value. So they want to deploy capital and invest in marketing to show that they have higher value. That's what they will do to keep their price high. Or they would launch what's called a fighter line. What's a fighter line? They will add a stripped down secondary product to meet cheaper rival head on. So if your rival is undercutting you, what you do is you will create a cheaper version of your product. A case in point is Apple cheap iPhone 17e. iPhone 17e don't have all the features that the full phone have, but it will compete with cheaper phone. That's without cutting the flagship price for the regular iPhone. Also, what happens sometimes, airline companies, they will advertise cheaper tickets. So when you search, you will see that cheaper ticket. But with that cheaper ticket, if you want to bring a luggage, it's an add-on. So somehow you will kind of differentiate your product, launch another type of product at a lower price to compete with those who are trying to undercut you. Or the worst thing you do is you match the lower price. And this is the fallback when the firm cannot credibly enhance value or segment its line. Here, what you do, you're going to sacrifice margin and can trigger retaliation. And basically, everybody is running down to the bottom. And that's why you don't want to start this cutting prices, because you're racing to the bottom. The second method is competitive bidding. So what's a bid? A bid is a formal offer to perform specific work or supply specific item at a specific price. It's used whenever buyers solicit competing offer instead of posting a fixed price. So you want to have your house painted. So you'll post something in the newspaper. I'm looking for someone, and I will give the job to the best price, and they will come in and they will bid on that work. This is what a bid is. We could have two types of bidding. We can have open bidding and sealed bidding. What's open bidding? Interested parties submit a sequence of competing offers that everyone else can see. So you make an offer, somebody else makes an offer, everybody sees each other's offer, and each can react to the others in real time. So the bidding continues until no one will improve their offer. This is what happens. So this is what you do. You want to buy a house, you put an offer, somebody else put an offer. Now, if the buyers are competing for a scarce asset, what does that mean? Let's assume you want to buy something that's rare, like a drilling right or a rare item at auction. What happens if you have a bidding? You're going to have a bidding war. The price will bid upward. So for scarce asset, if the question imply that if it's a scarce asset, the price should go up. If sellers competing for work, remember, I wanted someone to paint my house, an open process drive the price lower. So be careful in the multiple choice. What are you bidding for? Are you bidding for a rare item, or are you bidding for work? Because if it's an open bidding and everybody sees what everybody bidding, all offers are visible, and what happens, no one stays far out of step, and usually you will go downward to win the project, to win the contract. In a sealed close bidding, each competitor submits a secret offer that rivals cannot see, and this usually happens when you want to buy a home. The real estate, they would say it's sealed bidding. So you put your offer, and the seller will open the offer all at once, and they will grant the price to the highest bidder. The standard mechanism for awarding contract: public works, procurement, large supply agreement. That's what happened. So basically it's a closed envelope. But I said, if you want to buy a home, sometimes that's what you do. You place a bid, and the seller open all the envelope at a particular day and award the house, sells the house to the highest bidder. So contract work awarded by sealed bid, the lowest qualifying bids win. So if you want to do the work, they're going to give the work, generally speaking, assuming everything else is equal, to the person that want to charge them the least. Okay, so if I want to paint my home and someone offer me $3,000, another one $1,000, I'll give it to the $1,000. Because rivals' offers are secret, each bidder prices against its estimate of what competitors will do. So you have to guess what's your competitor doing, take that into account, and that's why it's part of competition-based pricing. And you're not only looking at the job intrinsic cost, you have to take into account what is your competition thinking, or what's their strength and weaknesses, and you have to take that into account as you are building your bid. Now let's talk about the bidder's dilemma. In a sealed bidding, every price that you put is a trade-off between two things: winning the contract and earning an acceptable margin. So if you bid too high, you win nothing. The competitor undercuts you and takes the contract because you bid too high. If you bid too low, guess what? You are going to win the job, but that the price that you bid fails to cover the cost or earn an acceptable margin. And this is called the winner's curse. You won, but you cannot make profit on your project. So you have to be aware, you have to balance those. Now there's a formula, they might ask you about it on the exam, and that's the expected profit. So the expected profit from bidding, you'll have the probability of winning. You would say, what's my probability of winning, times the bid price minus the relevant cost. So let's assume there's a project to complete a bridge, and you know the cost is 1.8 million. And here's what happened. Your cost is 1.8 million. You could bid either 2 million, 2.2, 2.4, 2.6. If you bid 2 million, you know, maybe the city or the county might be very happy with your bidding because 2 million is good enough for them. You're closer to cost. You might win, and if you win, the profit of one is 200,000, but the probability of winning is 80%. Therefore, the expected profit for this formula is 200,000. The profit times the probability equal to 160. If you bid 2.2 million, your profit if you won this contract is 400,000, but if you bid 2.2 million, the probability of winning this contract is 55%, so the expected profit is 220. If you bid 2.4 million, well, the profit is now 2.4 minus 1.8 million is 600,000, but the probability of winning when you bid 2.4 is lower. Notice as you ask for more, the probability of winning is lower. If you bid 2.6 million, your profit is 800,000, but there's a 10% chance if you tell them I'll complete the project with 2.6, and the expected profit is 800,000 times 10% is 80,000. So what you have to do is you have to say, what is my highest expected profit? Computed as the probability of win times, basically times the profit. And the profit is what you're bidding versus what you think it will cost you. For example, in this situation, based on everything, you should bid around 2.2 million. I'm sorry, you should bid around 400,000 because the expected profit is the highest on this level. Now let's take a look at target pricing and costing. Here the logic is reversal. In a cost plus, it's like a forward type of looking. We determine our cost, we add a markup, we get to the price. In target costing, we work backward. In target costing, we determine the price to be $100. We subtract a profit that we would like to have, and we say it should cost us $70 to produce this item. $70 to produce, we can sell it for $100, the profit is $30. So target pricing set the selling price first from market research and competitor analysis. So the price here is an external given. Again, competition-based pricing. We're looking at external forces. Target costing takes that price, subtract the required profit, and derives the maximum allowable cost to build the product. And this is what target pricing and costing. Let's look at an example. In a target cost, we look at the target selling price minus a required profit. Now there could be a cost gap. A cost gap means this is your current cost, but our current cost doesn't work with us, so we have to figure out a target cost. And what do? We talk to our engineer, we talk to the production people, we talk to our procurement. Let's bring the cost down to that level. So let's assume Lumen Audio wireless speaker, they have a market supported price for $80. So they know they can sell it for $80. Their audio wireless speakers, they want to earn 25%, so they want to earn $20. The target cost is 60. So if they can produce it at 60, they can sell it for 80, pocket $20 in profit. But right now, their current estimate to produce it is 68. Well, the difference between 68 and 60 is the cost gap, which is $8. What do they have to do? They have to go back and figure out how to reduce their production from 68 to 60. Now you might be saying, why don't they lift the price to 88? And if they lift the price to 88 minus 68, they would still be making $20. That's going to be less than 25%, but it's $20. Well, why can't they do that? Because the market won't bear it. Because if they charge $88, they won't be able to sell. Their competition will eat the lunch. Therefore, the design team must remove $8 of cost. How? Cheaper driver housing, fewer component, renegotiated battery contract, whatever is needed, until the speaker can be built for $60 and less, obviously. Only then production will proceed. What are the strength and limitation of target pricing and target costing? Imposed a disciplined, systematic focus on cost from the design stage onward. So you know how much it should cost you. You will start from the beginning with that in mind. Act at the point where most of the product cost is actually locked in. You already know, you should know what your cost is. Keep the firm honest about what the market would truly pay. You don't want to also inflate or deflate your price. The limitation is it exposes you to forces outside your control, like material price spikes, costlier technology. A market shift after the target is set can leave the price unrealistically high or low. So when you started this, you thought you can sell it for $80. By the time you produced it, now the market would only grant you $70, or it could be $90. Who knows, right? So aggressive cost target can pressure quality if managed properly, because now you need to cut corners to get to that cost. Sometimes it backfires. And this is a summary of all three approaches at a glance: going rate, competitive bidding, target pricing / costing. And it tells you all about what's the price anchored, what's the best setting, whose advantage is it, the key risk, the winning price, and on the exam how you might be tested. Let's take a look at this multiple choice question from farhatlectures.com. A smaller producer of refined table salt compete with 4 large national firms selling a chemically identical product priced at $4.20. Which pricing action is most consistent with the going rate pricing? So you know what the going rate pricing is. Simply put, do you know how it works? Well, A, price well above $4.20 to signal superior purity since salt buyers are quality sensitive. Is this consistent with the going rate pricing? Well, I hope not, because refined salt is a near perfect commodities. You cannot really differentiate. So any meaningful premium that you charge will drive your customer away. So that's not it. B, price at or near $4.20 in a homogeneous market, the prevailing price is a fair reference buyers accept. Is this the going rate pricing? I would say yes. If you price it at $4.15, $4.25, put it in a nicer package. If you want to do it at $4.15, put it in a cheaper package so customers don't care. They want to save the 5 pennies. And this is exactly what going rate pricing, something around $4.20. So I would say the answer is B, but let's look at C. Price far below $4.20 to capture the whole market, since the firm's small size makes a price war easy to win. Now, when you're a small size, you don't want to go into a price war because you could be wiped out, especially when you're competing against large national firms. So that's out. Add a fixed 40% markup to the firm unit cost, independent of the national. If you want to do that, you will basically shoot yourself in the foot. So the correct answer is B. What should you do now? Whether you are a CPA exam candidate, CMA exam candidate, accounting student, I recommend you go to Farhat Lectures, look at additional resources, multiple choice, true, false, exercises, simulation, cases. The best investment you can make is invest in yourself, and God bless.